Growth is not a law of nature. It is an exception, a brief period in human history that we mistakenly accepted as the norm. For millennia, economies existed in a state of relative equilibrium, where population growth was compensated by technological improvements, and periods of abundance alternated with periods of contraction. Only the last 2.5 centuries, a blink in the scale of civilization, have shown steady exponential growth. And now, this moment is ending. Financial markets are built on the assumption that tomorrow will be more than today. More customers, more transactions, more profit, higher stock prices. The entire architecture of modern capitalism rests on one axiom: the economy grows, and this will continue forever. Pension funds calculate future payments based on a 7% annual return. Corporations are valued based on discounted cash flows that assume revenue growth for decades to come. Public debt appears manageable only because GDP is constantly expanding, turning fixed obligations into a smaller share of the economy. But what happens when this axiom no longer works? The growth of the 20th century was a product of a unique confluence of circumstances. Cheap energy, first coal, then oil, allowed humanity, for the first time in history, to produce more using less human labor. A population explosion created an army of workers and consumers. Colonial expansion and later globalization opened new markets and sources of resources. Technological innovations, from the assembly line to the internet, accelerated productivity faster than opportunities were exhausted. Each of these pillars is now weakened or gone. Energy is no longer getting cheaper. On the contrary, the transition to renewables requires massive capital investments with lower energy density. Demographics have reversed. Developed countries are aging, and developing ones are reaching a plateau. Geographic expansion has ended. There are no unexplored territories left on the planet for extensive growth. Technologies still emerge, but their impact on aggregate productivity is slowing. Digitization creates value, but it is increasingly virtual and does not convert into a real increase in material well-being. GDP as a metric is beginning to fail. It counts activity, not outcomes. A hurricane destroying a city increases GDP through reconstruction work. The growth of medical spending on treating chronic diseases is also counted as growth, although it reflects a deterioration in the population's health. Producing disposable goods that break after a year boosts GDP more effectively than creating things that last decades. The measurement system has become detached from what it was supposed to measure. Moreover, GDP growth masks the degradation of basic systems. Environmental damage is not subtracted from economic indicators. Soil depletion, water pollution, loss of biodiversity, all of this is absent from the balance sheet. Growth can occur by shifting costs to the future or to other regions, creating an illusion of prosperity while actually depleting the resource base. Corporate financial reporting reflects the same problem. A corporation can show a profit while simultaneously destroying the environmental and social systems it depends on. Short-term returns do not account for long-term sustainability. Investors receive dividends from a company that is slowly eating away its own foundation. Systemic limits manifest not as sudden collapse, but as a gradual increase in friction. Resources do not disappear instantly, they just become more expensive to extract. Environmental systems do not break down abruptly. They lose resilience, become more volatile, require more effort to maintain. Social institutions do not collapse overnight. They gradually lose legitimacy, trust, and the ability to coordinate actions. Human attention is a non-renewable resource that is already depleted. The attention economy has reached its limits. It is impossible to endlessly increase the amount of content, advertising, and stimuli that consciousness processes. Growth in this sphere now means not expansion, but more aggressive intrusion into the same waking hours. Growth begins to accelerate the entropy of the system. Each new round of expansion requires more resources to maintain infrastructure, coordinate processes, and manage complexity. At a certain stage, the cost of growth exceeds its benefits, but metrics do not capture this. The economy continues to grow formally, but real well-being stagnates or declines. Investors live in a world of cognitive dissonance. They see slowing growth in developed economies, demographic problems, environmental crises, political fragmentation. But their asset valuation models still assume growth. Stocks are valued through P/E ratios, which only make sense in a growing economy. Bonds look safe only because it is assumed the economy will be large enough to service the debt. Real estate is expensive because prices are expected to continue rising. This is not an asset bubble. It is a bubble of expectations. Degrowth in this context is not an ideology or a political movement. It is the recognition that infinite growth in a finite system is mathematically impossible. Sooner or later, and likely sooner, economies will face the need to function without the assumption of constant expansion. The question is not whether degrowth is desirable. The question is how to adapt the financial system to a reality that no longer obeys the logic of expansion. When growth ceases to be the goal, the economy does not stop. It changes priorities. Transitioning from maximizing output to optimizing sustainability is not a degradation of the system, but a change in its function. Like an organism that stops growing after reaching maturity but continues to live, recover, and adapt. In a no-growth economy, the focus shifts from quantity to quality. Instead of producing more goods, creating goods that last longer, instead of constant replacement, repair and modernization, instead of disposability, cyclical use of materials. This is not regression to a pre-industrial era, but a transition to a higher form of economic organization, where value is measured not by the rate of consumption, but by the efficiency of resource use. Circularity becomes a central principle. The linear model of extraction, production, consumption, disposal is replaced by closed cycles, where waste from one process becomes raw material for another. Materials do not disappear after use, but return to the production chain. This is not a moral choice, but an economic necessity. In a world without growth, it is impossible to constantly increase the consumption of primary resources. The ownership model transforms. Instead of buying things, people gain access to services. Cars are replaced by transportation services. Tools and equipment become shared resources accessible through rental systems. Clothing, electronics, furniture move to subscription models where the producer retains ownership and is responsible for repair, updates, and disposal. This radically changes the economy. Companies are interested in product durability because they bear the costs of its support. Repair becomes more profitable than producing new. In a growing economy, repair was a marginal activity. It was cheaper to throw away the old and buy new. In a no-growth economy, the logic flips. Extending the lifespan of things saves resources, energy, and capital. An entire industry of servicing, restoration, and modernization emerges, creating jobs and added value without increasing material consumption. Localization takes on new meaning. This is not a political slogan about protecting local production, but a financial strategy to reduce risks. Long supply chains are efficient in a stable, growing economy, where cost optimization is more important than resilience. But when growth slows and volatility increases, the advantage goes to shorter, more controlled connections. Local production is more expensive per unit of output, but cheaper in risk management. Regional economies become more autonomous, not out of ideology, but pragmatism. Money in a degrowth system changes its nature. It remains a medium of exchange and distribution, but loses its primary function as a store of value. In a growing economy, money is a claim on future growth. You save today, tomorrow you get more because the economy expanded. In a no-growth economy, savings do not bring real returns. Money retains purchasing power, but does not increase it. This reduces the velocity of capital circulation. Less speculation, fewer short-term investments counting on rapid value growth. Capital moves slower but more predictably. Investors focus not on upside, but on the stability of cash flows. Instead of betting on exponential growth, focus on stable, albeit small, incomes. Financial instruments adapt. Bonds become more attractive relative to stocks because fixed income is more reliable than unfulfilled growth expectations. Dividend stocks are valued higher than growth stocks. New types of contracts appear, tied not to business expansion, but to maintaining operations. Investments are directed not at scaling, but at increasing efficiency and reducing dependence on external factors. It's important to understand, degrowth does not abolish capitalism. It abolishes the growth premium. Profit is possible even without market expansion, through process optimization, quality improvement, creating sustainable competitive advantages. But this profit is not exponential. It is linear or even stable at one level. Companies remain profitable but stop being unicorns, promising tenfold growth in 5 years. A no-growth economy is an economy of sufficiency, not poverty, but a conscious rejection of excess. Production continues, but its volume is determined by real needs, not artificially stimulated demand. Marketing loses its function of creating desires and returns to informing about available solutions. Consumption becomes more conscious, not out of moralism, but because excessive consumption becomes economically disadvantageous. Working hours decrease. In a growing economy, increased productivity is directed at increasing output. In a no-growth economy, at reducing working hours. If the same can be produced in less time, there is no need to invent new needs to occupy freed-up capacity. People work less, earn enough for a comfortable life, and have more time for activities not related to consumption. Inequality becomes a central issue, not for ethical reasons, but economic ones. In a growing economy, inequality is tolerated because the lower strata also receive increases in well-being, albeit smaller. In a stagnating or contracting economy, wealth concentration at the top means absolute impoverishment of the bottom, leading to social instability and institutional destruction. Redistribution becomes not a matter of justice, but a condition for the system's survival. Innovation does not cease, but it is directed not at creating new markets, but at solving existing problems. Technologies that reduce resource consumption, increase durability, simplify repair, become more valuable than technologies that create new forms of consumption. R&D is financed not by venture funds seeking a unicorn, but by long-term investors interested in fundamental improvements. The state changes its role. Instead of stimulating growth through credit expansion and consumption subsidies, it focuses on maintaining basic infrastructure, ensuring social stability, and regulating resource flows. Fiscal policy is built not on growing tax revenues, but on balanced budgets. Debt ceases to be a tool for pulling growth from the future into the present and returns to its original function, temporarily smoothing shocks. A no-growth economy does not mean stagnation. It means stability. Not the absence of change, but changes aimed at improving the quality of life, not increasing the volume of consumption. This is an economy that can exist indefinitely because it does not deplete its resource base and does not create irredeemable obligations to the future. In a world without growth, assets are divided not by yield, but by survivability. The criterion of value shifts from the potential to increase in price to the ability to retain function under conditions of a stable or contracting economy. An investor's portfolio no longer aims to maximize profit, but is optimized to minimize losses and preserve purchasing power. Basic infrastructure becomes an anchor asset. Systems providing fundamental needs, water, energy, waste disposal, transportation, retain value regardless of economic growth. Moreover, under degrowth conditions, their importance increases because they do not require demand expansion to maintain profitability. A water utility provides stable income at any size of the economy. Electricity grids are always needed. Waste recycling becomes critically important when primary resources become more expensive. Infrastructure investments change their logic. Instead of building new facilities, modernizing and maintaining existing ones. Instead of expanding networks, increasing their efficiency and reliability. The yield of such assets is not high, but predictable and sustainable. These are assets for pension funds and long-term investors who need stability, not growth. Land with productive function returns to the center of the economy. But not land as a speculation object, but land as a source of real output. Agricultural land, forests, fisheries. In a growing economy, land value is determined by its development potential or resale. In a no-growth economy, land is valuable for its ability to produce food, materials, renewable energy. Productive land becomes an asset with protection against inflation and scarcity. Food is always needed. Sustainably grown timber is a renewable resource. Land under solar panels or wind turbines generates energy. Importantly, these assets do not require consumption growth to retain value. Demand for calories is stable. Land that can feed 100 people today will be able to feed 100 people in 20 years. Housing stops being an investment and returns to its use function. In a growing economy, real estate was a way to accumulate capital. Buy cheap, sell expensive. In a no-growth economy, housing prices stabilize or fall relative to incomes. Housing becomes a place to live, not a financial instrument. This is a painful transition for those who invested savings in real estate expecting growth, but inevitable. Long-term housing value is determined by its quality, durability, and efficiency. Houses built to last centuries with low energy consumption, repairability, and adaptability retain value. Cheap construction, designed for quick sale, loses appeal. The rental market stabilizes because housing stops appreciating faster than incomes. Social capital, perhaps the most undervalued asset in a growth economy, comes to the fore. These are networks of trust, cooperative structures, mutual aid, institutions that allow coordinating actions without centralized coercion. In a growing economy, social capital was a nice addition. In a no-growth economy, it becomes a necessity. Cooperatives, from consumer to production, show resilience under stagnation conditions. They are not focused on maximizing profit for external shareholders, but on meeting members' needs. The cooperative model naturally fits the logic of degrowth. Instead of endless expansion, stable provision of quality goods and services. Mutual insurance systems replace commercial insurance companies under conditions where risks become less predictable and return expectations lower. Mutual insurance operates on the principle of risk distribution within a community, without profit extraction by intermediaries. In a world of growing volatility and declining growth, such a model is more efficient. New types of financial instruments adapt to the reality without expansion. Rents, incomes from owning assets that do not require growth to generate cash flows, become the basis of investment portfolios. Land rent, rental payments, fees for access to infrastructure, all are stable income sources. Service models replace selling goods. Companies that sell not things but access to their functions are better suited to a no-growth economy. Their profitability does not depend on constantly increasing the number of buyers. They earn from long-term relationships with customers, from servicing and support, not from one-time transactions. Maintenance models, contracts for maintaining the operability of systems, become the main source of corporate income. Instead of selling new equipment every few years, companies sign long-term agreements to service existing equipment. This benefits both sides. The client gets predictable costs and performance guarantees. The producer gets stable income. Slow money, the concept of investing with a horizon of decades, not quarters, stops being a niche for philanthropists and becomes mainstream. Funds that can wait gain an advantage. Fast money, focused on short-term speculation and growth, loses its footing. Trap assets in a degrowth economy become obvious. Growth equity, stocks of companies valued based on future growth that does not materialize, turn into toxic investments. Startups promising a 100-fold return in 5 years are left without funding. Venture capital as an industry shrinks because the high-risk, high-return model works only in an expanding economy. Technologies that do not reduce costs, but create new needs, lose investment appeal. Gadgets requiring constant updates, platforms living off user growth, services monetizing attention. All this works while the economy grows and consumers have excess resources. Under stagnation, demand for non-essentials shrinks first. Financial products tied to constant consumption expansion depreciate. Credit cards with loyalty programs encouraging spending. Consumer loans for buying unnecessary goods. Mortgages based on the borrower's income growth. All this stops working when people earn roughly the same year after year and do not expect improvement. Crypto assets face an existential crisis. Their value largely rested on the growth narrative. The more people join the network, the more expensive the token. In a no-growth economy, this narrative breaks. Cryptocurrencies may retain their function as a medium of exchange, but lose their function as a speculative asset and digital gold. Luxury goods and status symbols depreciate relative to basic needs. In a growing economy, rising incomes at the top created a market for increasingly expensive status signals. In a stable economy, status consumption shrinks. Luxury stops being an investment. Collectible watches, art, premium cars lose their ability to appreciate. An investor in a degrowth world builds a portfolio not from assets with maximum growth potential, but from assets with minimal risk of depreciation. This is a conservative strategy, but not a passive one. It requires a deep understanding of which needs will remain unchanged, which systems are critical, which connections are reliable. This is a shift from financial engineering to economic realism. Degrowth breaks not markets, it breaks expectations. And it is the gap between expectations and reality that creates the greatest risks. The modern financial system is built on faith in growth. When this faith disappears, structural problems that could be ignored under expansion conditions are exposed. Pension systems, the first and most obvious point of tension. Most pension funds assume a 6 to 7% annual return. This return is only possible in a growing economy, where stocks appreciate and corporations increase profits. In a world without growth, such indicators are unattainable. Real returns approach zero or become negative. The math of pensions collapses. Promises made to today's workers cannot be fulfilled from future investment income. The choice becomes harsh. Either cut payments or raise contributions, or push back the retirement age, or shift the burden to the state, which itself suffers from the lack of growth in tax revenues. Any decision is politically toxic and socially destabilizing. The problem is exacerbated by demographics. A pension system works when there are more workers than retirees. But in all developed countries, the ratio is shifting in the opposite direction. Fewer workers must support more retirees under conditions where the economy does not grow. This is unsolvable within the current model. Public and corporate debt becomes unmanageable. Debt is tolerable as long as the economy grows faster than obligations accumulate. Then debt as a share of GDP decreases over time. But in a stagnating economy, debt grows relative to production. Servicing loans requires an increasing share of the budget or revenue. At some point, debt becomes unrepayable. Defaults are inevitable. The question is not whether they will happen, but in what form. Direct default, refusal to pay, destroys trust and leads to financial crisis. Inflationary default, devaluing debt through inflation, shifts losses to creditors and savers. Restructuring, stretching payments and writing off part of the debt, requires coordination that may not materialize. Any path is painful. Corporations loaded with debt to finance expansion find themselves trapped. Loans were taken assuming revenue growth. When revenue stagnates, debt service eats up profit. Companies start cutting investments, laying off employees, selling off assets. Some will survive through restructuring. Many will go bankrupt. The banking system faces an asset crisis. Banks hold on their balance sheets loans issued under growth assumptions: mortgages, business loans, corporate bonds. If growth does not materialize, a significant portion of these assets becomes non-performing. Delinquencies rise, collateral values fall. Bank capital is eroded. Without economic growth, banks cannot earn enough to cover losses. Governments may try to save banks, as in 2008, but in a no-growth economy, such a rescue merely shifts the problem from the private to the public sector, increasing already unbearable public debt. Monetization of debt by central banks leads to inflation without production growth. Stagflation, the worst possible scenario. Social risks accumulate slowly but explode abruptly. Generations raised expecting growth, a better job, a bigger house, a higher standard of living than their parents, face the reality of stagnation. This is not just economic disappointment, it is the collapse of a life narrative. The conflict between the habit of growth and the new reality manifests as political polarization. Voters demand the return of growth. Politicians promise to bring it back. But structural constraints make growth impossible. Promises are not kept. Trust in institutions falls. The electorate radicalizes. Movements emerge promising simple solutions. Close borders, leave trade unions, expropriate wealth, nationalize resources. Loss of status is a source of deep social instability. In a growing economy, people can climb the social ladder. In a stagnating one, if someone rises, someone else necessarily falls. The gain becomes zero-sum. This generates fierce competition for positions and resources, destroys solidarity, intensifies conflicts along class, generational, regional, ethnic lines. The middle class, which was a buffer of stability in the 20th century, erodes. Some move down, losing economic security. Some rise into the elite, detaching from the rest. The center dissipates. Society polarizes between haves and have-nots, between those who adapted to the new reality and those who demand a return to the old. The politicization of rejecting growth is inevitable. Degrowth can become the ideology of the elite who have already secured their comfort and now preach limitation for others. This provokes justified anger from those who have not yet reached a basic level of well-being. A just transition to a no-growth economy requires redistribution of existing wealth, not freezing current inequality. Without this, degrowth is perceived as a convenient ideology for the rich. Psychological risks are underestimated. An investor without upside loses motivation. Why take risks if the maximum one can hope for is capital preservation? An economy without success, without stories of someone getting rich, building an empire, changing the world, loses appeal. Entrepreneurial culture fades. People stop trying. The fear of stagnation as a cultural trauma is deeper than economic indicators. Western civilization for the last 2 centuries identified itself with progress, growth, expansion. The idea that the future will not be better than the present, that children will not live richer than their parents, that humanity has peaked and will now only maintain what has been achieved, this is a blow to identity. Non-hedgeable factors, risks that cannot be protected against with financial instruments. Collective rejection of degrowth may lead to attempts to artificially stimulate growth at any cost. Governments may launch massive credit expansion programs, print money without limits, subsidize consumption, increase military spending. This will create a temporary illusion of growth, but worsen structural problems and delay the inevitable adjustment. Ideological rollbacks, returning to fossil fuels, abandoning environmental norms, Removing restrictions on resource exploitation may give short-term production growth, but this is growth at the expense of the future. Resources will be depleted faster, environmental systems will degrade more, social conflicts will intensify. Attempting to avoid degrowth will lead to a harsher collapse later. The risk is not that degrowth will happen. The risk is that it will happen chaotically, through crises, defaults, social explosions, and political catastrophes. A managed transition to a no-growth economy is possible, but requires acknowledging reality sooner, before reality forces acknowledgement through destruction. The longer adaptation is postponed, the more painful it will be. The new role of capital in an economy without expansion is not the degradation of finance, but its evolution. The investor stops being an agent of growth and becomes an agent of stability. This is a radical change of function, but not an abandonment of capitalism. Capital remains. Its purpose changes. In a growing economy, the investor looked for assets that would increase in price. The logic is simple. Buy cheap, sell expensive, the difference is profit. Economic growth made this strategy work for most assets. It was enough to buy an index fund and wait. The market grew, the portfolio grew. Even mediocre decisions brought income because the rising tide lifted all boats. In a no-growth economy, this logic does not work. Assets do not automatically appreciate. Prices stabilize. Profit from resale disappears. Portfolio yield is determined not by asset price growth, but by the cash flows they generate: dividends, rent, interest, royalties. The investor shifts from capital gains to income investing. This requires different thinking. Not how much will this asset be worth in 5 years, but what sustainable income does it bring? How likely is it that this income will persist? What risks could interrupt it? Asset valuation becomes more fundamental, less speculative. Financial analysis returns to basics. Instead of complex growth valuation models, simple discounted cash flow calculations. Instead of faith in narratives, balance sheet analysis. Instead of technical analysis of charts, understanding the real business. This is less exciting investing, but more honest. The investor as stabilizer is one who invests capital in systems that must continue to operate. Not in expansion, but in maintenance. Not in scaling, but in increasing reliability. Capital is directed to modernizing infrastructure, improving efficiency, reducing dependence on external shocks. Such an investor does not expect tenfold returns. They are satisfied with a small but predictable return. 3 to 4% annually in real terms. That is success. The main thing is that these 3% are reliable, that the asset continues to generate income in 10, 20, 50 years. Compounding modest but stable returns over the long term outperforms speculative booms and busts. Long-term thinking becomes not a declaration, but a necessity. In a growing economy, one could play on short-term fluctuations, shift from asset to asset, catch trends, trade news. In a stagnating economy, volatility decreases, speculative opportunities shrink, transaction costs eat up profit. Only long-term ownership of quality assets makes sense. Buy and hold turns from a passive strategy into an active philosophy. Find the right assets, understand their fundamental value, buy at a reasonable price, and hold, ignoring short-term fluctuations. This requires patience, discipline, confidence in one's own analysis. This is the opposite of the culture of fast money, constant trading. A stability portfolio looks different from a growth portfolio. Fewer stocks of technology companies promising revolution. More bonds of stable issuers. More infrastructure assets. More direct investments in production cooperatives and local enterprises. More real assets, land, real estate for use, tangible goods with long service life. Thinking shifts from more to enough. Enough income for a comfortable life. Enough security for a peaceful old age. Enough diversification to protect against crises. Not maximum, but optimum. This requires redefining goals. Instead of becoming rich, not becoming poor. Instead of doubling capital, preserving purchasing power. Psychologically, this is harder than it seems. Humans are wired to strive for more. The feeling of progress is a powerful motivator. Seeing a growing bank account is pleasant. Rejecting growth is perceived as abandoning ambitions, drive, meaning. But this is an illusion. Sufficiency is not the absence of goals. It is redefining goals from quantitative to qualitative. An investor in a degrowth world can strive not for wealth growth, but for growth in the resilience of their position. Not for increasing the portfolio, but for strengthening it. Not for bigger numbers in the account, but for greater confidence in tomorrow. This is also progress, just measured differently. Calm instead of anxiety. Stability instead of volatility. Confidence instead of hope for luck. The investor who understands this already lives in the future. They have built a portfolio for stability. They have accepted that getting richer is no longer possible, but becoming poorer is, and the task is not to become poor. They invest in systems that will work when others collapse. They participate in cooperatives, support the local economy, own productive assets, are diversified geographically and sectorally. They are calm. Not because the future is predictable, it is not, but because they are ready for unpredictability. Their assets are not tied to one scenario. They can adapt. They understand that the only constant is change, and the only strategy is flexibility and resilience. The others are still catching up. They are still looking for the next growth stock, the next unicorn, the next boom. They believe growth will return, that this is temporary stagnation, that technology or politics will fix everything. Perhaps they are right. Perhaps a miracle will happen and growth will resume. But the degrowth investor does not rely on miracles. They rely on reality. And reality says, resources are limited. The planet is finite. Growth cannot continue forever. And if you build a strategy on the assumption that the impossible becomes possible, you are not a strategist. You are a dreamer. And markets do not forgive dreamers when dreams shatter against reality. An economy without growth is not a poor economy. It is an economy where value is measured not by speed, but by what remains when growth has ended. Capital does not disappear in the absence of expansion. It changes form. From speculative to stabilizing. From aggressive to conservative. From short-term to long-term. It ceases to be a means of multiplying wealth and becomes a means of preserving structure, maintaining systems, ensuring continuity. This is a painful transition for those who grew up in the paradigm of growth. For those accustomed to measuring success in percentages of capital growth. For those who built plans based on the assumption that tomorrow will be more than today. For those whose identity is tied to accumulation, expansion, conquering new heights. But this transition is inevitable. Mathematics leaves no choice. Infinite growth in a finite system is impossible. The transition point is already near. Perhaps it has already been passed, we just haven't acknowledged it yet. Data hints: slowing productivity growth, stagnation of real incomes, debt growing faster than the economy, exhaustion of demographic dividends, approaching planetary boundaries. The investor who understands this before others gains an advantage. Not an advantage in yield, that no longer exists. An advantage in survival. While others continue to invest in growth assets that will not deliver growth, they build a portfolio of resilience. While others wait for the old times to return, they adapt to the new. While others deny reality, they accept it and act based on it. Degrowth is not the end of capitalism. It is the end of a certain version of capitalism that was only possible under the unique confluence of circumstances in the 20th century. Cheap energy, demographic growth, geographic expansion, technological breakthroughs. All this created the possibility for exponential growth. This confluence is ending. Capitalism without growth is different, but still capitalism. Capital will remain. Markets will remain. Investments will remain. Profit will remain. But they will operate by different rules. The rules of degrowth. Not to accelerate, but to hold. Not to scale, but to maintain. Not to extract maximum, but to preserve the minimum necessary for the functioning of the systems on which life depends. The investor in this world is not a hero or a villain. They are an agent of reality. They acknowledge that growth has ended and act based on this fact. They do not protest the new regime or mourn the old. They simply adapted. And in an economy that no longer forgives mistakes, where there is no growth to compensate for wrong decisions, the ability to adapt is the only sustainable competitive advantage. And those who have not adapted will learn from their own losses. Markets are merciless to those who ignore reality. And reality now is this: growth is no longer an axiom. It has become an exception, a product of special conditions. And these conditions have vanished. What remains when growth has ended? The economy remains, production remains, consumption remains, exchange remains, capital remains, investors remain. They simply all operate in a new mode. The mode is called degrowth. But this is not a catastrophe. It is a new normal. The degrowth mode is not stagnation in a negative sense. It is stabilization. Strange for those who remember growth. Natural for those born into it, who will know no other. To them, the idea of infinite growth will seem strange, as the divine right of kings seems strange to us today. Obvious in its time, absurd in retrospect. A future without growth does not mean a future without prosperity. Prosperity has always been a relative concept. It depends not on the absolute size of the economy, but on how efficiently resources are distributed, how resilient systems are, how stable life is, how fair society is, how much people have access to what they need for a dignified life. A degrowth economy can be prosperous. Simply, prosperity is measured not by GDP growth rate, but by the quality of life it provides. Not by how much we produce, but by how well we live on what we produce. Not by the quantity of things, but by their quality and durability. Not by the speed of change, but by the resilience of systems. Not by the size of wealth, but by its distribution. This requires redefining success for society, for companies, for investors, for every person. Success is no longer more. Success is enough and it will last. Enough food, shelter, healthcare, education, security. And this is not temporary, not at the expense of the future, not at the expense of other regions or ecosystems. It is sustainable. The investor who understands this already lives in the future. The others are still catching up. A financial future without infinite GDP is not a dystopia. It is simply a different future. Less dynamic, but more resilient. Less exciting, but more predictable. Less unequal because growth no longer justifies wealth concentration. Less consumerist because consumption is limited by real needs, not artificially stimulated desires. This is a future where the economy serves life, not life serves the economy. Where the goal of production is to meet needs, not growth for growth's sake. Where capital is a tool, not a goal. Where the investor is a steward of resources, not a speculator. Where success is resilience, not expansion. Degrowth is inevitable. The only question is whether we will arrive at it through a managed transition or through crisis. Through conscious decision or forced adaptation? Through planning or through chaos? Choice is still possible, but the window is closing. Each year of denial narrows the room for maneuver. The investor who understands this today acts today. They do not wait for confirmation from the mainstream. They do not wait for everyone to understand. Because when everyone understands, it will be too late. The assets that work in degrowth will become expensive once the masses realize the new reality. The advantage of early action is that you buy cheap what others have not yet valued. This is not a call to action. It is simply analysis. A cold, analytical look at where the economy is heading. Draw your own conclusions. Make your own investment decisions. But remember, reality does not care about your preferences. It simply is. And sooner or later, everyone will face it. The question is, will you be among those who are prepared? Or among those who ask in surprise, how did this happen? Why weren't we warned? The warning has been given. The data is available. The analysis is done. The rest is your choice.